Watching and learning today.
Well, yeah, sorry, man. I was on mute there. But yes, everything. Yeah, happy early Turkey Day, as you said. Fun times going on.
Just dropped my daughter
And
off.
nice. Yeah, we'll let some folks kind of trickle in here, and then we'll get things rocking and rolling. But welcome all. It's always a pleasure to host these Wednesday notebook reviews. We got a little early bird special this week, which is always great. And apologies for kind of shifting the time up a little bit. This week, and it'll be next week as well. We're gonna do it on Tuesday at 2 p.m. My daughter's birthday is on Wednesday the 30th, so she that little 3-year-old rules the roost. No, I'm just kidding, but I just want to make sure that I'm focused on her in the afternoon and stuff like that. So next week will be on Tuesday at 2 p.m. and I'll be in studio, which will be great. But this week we are, yes, we got lots going on. Obviously, we got some things happening out in the markets in terms of VIX down at the kind of low end of the risk range. And actually, Genron's telling me I'm scheduled for Monday, and he is accurate. The weekly notebook review is actually on Monday next week. So my bad, I had the times mixed up. So Genron, thank you for being in my ear and for giving me the heads up live. But we got lots to talk about here. So let's kind of dive into it. And as a reminder, this is not investment advice, and please refer to the Hedgeye kind of disclaimer here for the weekly notebook review. I'll pin that in the nest here in a minute, but now we can jump into it. So we got the VIX moving down to the kind of low end of the risk range. Obviously, it's at 20.91, which technically is below the 21.03 that was published this morning. But again, these things are dynamic, so don't freak out about it. The trend ranges are there. We don't have that on the VIX per se, but certainly kind of cross-reference the daily range with any of your ETF Pro products that you have out there, and the trend ranges there. And that's going to give you a bit of a better idea as to where things might live, right? So XLK is kind of a good example, which I've pulled up on my screen. So again, if you're listening in live, feel free to either jump over to the Hedgeye website or to the Hedgeye YouTube channel. You can kind of listen in on both and get to share my screen here. So the thing, what I'm showing you with XLK is really the trend range. So that would be this range here on the left hand side. That's going to be the longer term. So incorporating volume, price volume, and volatility on a 3-month or more basis. And you can see here the daily range, kind of top end is around 135 and a quarter. The top end on the trending basis is closer to it was actually at 130.38. So we still have a bit of room to go on that top side. So again, kind of just be patient, execute. I just saw a real-time alert come in from Coach on one of the shorts we had out there, so he was covering that. So again, just it's one of the beauties of doing it real time and live during market hours is we get to coach through and review the notebook, obviously with real time pricing in terms of what's going out there, right? So evaluating some of the maybe feelings or emotions that might be happening, and I'll reiterate what I had posted, what I tweeted out this morning, which is although those kind of negative I should say eyeball discounts are in place at the moment, and certainly increased on a day over day and week over week basis, as I shared. We just got to remember it's like one tool in the toolbox, right? And the bigger takeaway right now of the last 2 days would be the consolidating risk ranges. So those, it's the lower highs, but then also higher lows that are happening. So, as of kind of even just a week ago, the low end of the risk range on, say, the S&P, if I go to 1116, was down at 36.35, which would have been, all the way down kind of this level here, which would have made a new 1 month low, not quite a 3 month low, but certainly a 1 month low. And now we're kind of right at the the low from in today's range, kind of from earlier in November. So just kind of keeping those things in mind, reviewing the top end and the bottom end of the risk ranges and how they're factoring in and what they're kind of sort of quote unquote the probabilistic kind of predictability there, right? In terms of, it's just math. They can go from the top end of the range to the bottom end of the range, really overnight or intraday. So just kind of, again, keep that in mind as we move along here, and act accordingly. But really what those consolidation signals are really confirming or is that we're squarely in the chop bucket. You're seeing that in the VIX risk range again, kind of from weekend work to today, which is really what this show and this call is all about. That's even just, it was a call out for me over the weekend and really over the last kind of 2 weeks, but especially over the weekend. And then it's been kind of squarely confirmed as we are midweek here, with the VIX kind of top end well within 27 and really just kind of north of 26. The other things too, obviously, to be pointing out would be, the pivots that are happening out there, right? So it's managing these pivots. So it's managing these consolidation, how the risk ranges are consolidating, managing our expectations and kind of emotions there, because we do see the quad data that's rolling in, Drago and Ritchie and Jonesy. Put together a great macro show, kind of reviewing the data across the world, really. And so, I'd highly recommend kind of going back and rewatching that and kind of taking some diligent notes there. But at the end of the day, sometimes it's hard for us within Hedgeye Nation to um, have that data and see that data rolling in and understand what the next couple quarters can look like versus what the market is doing today, right? So I think just kind of trying to have balance both sides of the brain and balance both the kind of the here and now versus the longer term, and really just remembering that we've captured this full investing cycle to date, right? So far, certainly year to date, really well, and there's no there's no reason to kind of try to force anything when the market's not signifying kind of new lows and the big breakdown to new lows. So why force it? Just sort of be patient, take what the market's given you and execute, but remember to execute accordingly, right? So there's a real time alert that went out this morning on a core short that we've had on since Q1 of 2022. And so again, I mean, just going back to the wood on some of these core shorts, but then also staying patient on ones that either aren't quite at the top of the range or might just be kind of putting in a signal that a consolidating signal, right? So kind of just being patient for confirmation there. But that's kind of what's on my brain right now. And then obviously on the pivots there, we've had a couple of big ones. Certainly what would be considered a more traditional kind of quad four asset allocations. And if you've been paying attention in the last week or so, that shouldn't surprise you. But a big call out for me today, which wasn't highlighted because on the macro show, since it was really focused on kind of more global macro data, would be the natty gas, right? So natty gas turned a bullish trend today on the signal, and that's yeah. So that's really something to be. I don't know. It's not even. I don't know if it's be paying it. Well, certainly be paying attention to. Is there anything to act on that? Not really sure. At least not at this point in time, where we're kind of it's up close to the top end of the risk range. But obviously, that is a change, and it's always important to kind of navigate through, changes and updates to signals and that kind of thing. So, again, keep in mind what's happening there. Conversely, on oil, that put in some really big lower lows and lower highs today, and we're actually kind of near the low end of the risk range. So if you're, I'd say if you're kind of short oil, I would certainly be, kind of bringing it down. This is a great opportunity in the chop bucket. You got to remember to kind of, work incrementally and move that inventory from your mid maxes and back down again. So, this is, it's it's an interesting kind of, I guess, tale of two stories here with oil really confirming the bearish, trade and trend, whereas natty gas has moved to bullish trend. So again, do I have to do anything with that? No, it's just something to be. We got Other Side Asset Management, who's back in the house after being Twitter suspended for about a week. So welcome back, Mitchell. It's always a pleasure to have you on the weekly notebook review. Yeah,
Thanks,
man.
brother.
Anything on your notebook that I not necessarily missed, but just haven't quite covered yet?
No, I think you went over most of it. I mean, we're the big important guys are, well, everything's important, but dollar is dollar is right there below trade, but above trend. So that's one that I'm keeping a very close eye on. As Keith always talks about, that is the one single indicator if he had to choose one, right? So, it seems, well, seems like a lot of what's going on appears to be a very similar trade, but we do have those um, uh, change in regime, as you suggest, or as you kind of put it that way. Gold is starting to perk itself up. A lot of the quad four longs that would typically work in a traditional quad four are starting to work. So those are things that I'm looking to find myself into, but I'm doing my best to exercise patience as the VIX is at the low end of the range, and a lot of them are at the top ends of their respective ranges. So yeah, I'm trying to be I'm trying to be patient right now, and I've made a few small little moves here and there, but I am trying to be patient. My biggest problem is going top to bottom or bottom to top quickly enough in my holdings. When things are at the bottom end of the ranges, get as close to my mins as possible relative to when they're at the top ends of the ranges, sell down to those mins, right? So
Yeah, and listen, it's squarely a reflection of the chop bucket, right? We can go from 21 on the VIX to 26 on the VIX, in a day, and it's kind of a tale of two stories, right? I know I've said that kind of twice now, but I think that's the chop, right? You can really chop you up, and so if you're either, you either kind of have to decide whether or not you kind of be on the sidelines a little bit before, stepping back in or really taking action, or if you do have the kind of wherewithal and capabilities of navigating and trading the chop, because it's not for everybody, and I think that's a personal decision, right? In terms of what you're able to do and what you're capable of doing and what you're comfortable doing. And
well,
so again, yeah.
well, a little bit less on the chop, more so on, as you and I offline a couple days ago talked about, more so when the VIX is straddling a regime, right? When the VIX is straddling a regime, I need to give equal focus to both ends of the probability as opposed to just focusing on the top end, right? So uh, when the VIX was 26 to 35, I'm still focused on, I have to evaluate myself. Was I focused on 35 more than I was on, you know, 26 or 27? And then as the top end started to come down and the VIX fell below the F bucket, do you how do you play that one a little bit more? Do you get a little bit less aggressive now that you're out of the the F bucket for the day? Like, and if it's only a cup of coffee and it gets back into the F bucket, do you then uh, get more aggressive on it, or do you or I have to get better at playing that. But outside of that, just you pretty much ran the bases.
Awesome. Arthur, you jumped up. What's on your mind?
Hey, how you guys doing? Good.
Doing well.
Yeah, I just sent out a tweet. I'm irresponsibly short high yield. and so and that was with the last RTA, so that just got me right there. So my question, and I'm hoping maybe someone could give me a comment on, is based on their experience, what's the you feel that has the best symmetry to pair off your high yield or junk short against long?
That's a good question. I don't have a back-tested answer for that, Arthur. So I can come back. I can come back to you. Trend just jumped up, so I don't know if he does, if he has one. But
and I don't do any. I know Trend. I've not talked to Trend, but I've listened to him before, and I didn't take his advice because I'm not as good as he is as far as going against individual high yield stuff rather than the ETF itself. But I primarily work in the ETF space.
Sure.
That's what I'm comfortable with. So I'm looking to pair. I've got obviously some longs against high yield, but I'm not sure it's the best way to go. And that's kind of where I'm looking.
Yeah. So sorry, Trent. Yeah. Do you have a kind of?
Yeah, real quick. So think of what your trade would work for and what would your trade work against, right? So JNK tends to rally whenever there's a risk on rally, like we are having some sort of a relief rally at the moment.
Right.
So if you want to have something long against it, because you're having an ETF which is fairly diversified, you'd want to have something which is high beta diversified against it, just to pair it up. Now that is if you want to pair it up. But the true pairing from an alpha sense would be something which wouldn't fall as much as junk would fall when you have the other way around too. So you're not just thinking about, hey, what do I do when junk starts rallying against me or HYG starts rallying against me? You have to also think about what will fall less when the HYG or junk starts falling, right? So think of strengths in that sense, meaning typically in quad 4, the portions of XLV and portions of XLP, which is staples. So staples or healthcare tends to work well. So if you have good signals on high beta healthcare and or uh, consumer staples names, then those might be decent pairs, because eventually when you start getting the slamming, you probably may have some support from the other factor, which is a sector factor for those names. So that's the only thing I could suggest in this specific aspect. But I tend, when you say responsibly short, just curious, like, is it more than 5% of your portfolio? Is it more than 10% of your portfolio? What is?
I'm right. I'm with today's ad, and I'm already. I've even got the options on, so I'm about. So that's where how Keith typically, I've been a course short, been holding it, and it's been working well. And then when it gets up here in this top end here, the last couple days, and then I saw today you went, and I went, oh God, I got to go a little bit more. So I'm there, and I'm kind of there. And I guess the part that makes me a little concerned is this old wall year-end bullshit markup stuff that seems to be going on, no volume. And, you got to deal with that. It is what it is. So, and I'm already long XLP, XLV against it. Probably just got to get a little bit heavier into those as this. And, I'm not, who knows, maybe the year end, maybe it'll get blown up by the CPI and Powell on the 12th and the 13th. Who knows? Be nice. But especially if everyone gets on the wrong side before then. But
Yeah, for year end, I mean, just to make sure that we all are on same page, 2018 year end, everybody kept saying the same thing.
Yep, I remember.
Right?
I was there, and it just crashed, man.
Yeah, when rates were being hiked, right? So I think when we are comparing like for like, we do need to think about it that way as well. That okay, there's a seasonality which is a headwind to you from because you're short, right?
Yeah.
And then there's a how much that seasonality would play in, what would be the factors that would play in for that seasonality, and then also keep watching the signal, right? Like the price volume signal, what is it, price volume volatility signal, what is it suggesting right now? Price volume volatility signal is suggesting some sort of relief rally at the moment. So that's where it would be important to have both long short portfolio,
Right.
not just a short portfolio. So long would be, definitely on RTA there are some longs that are suggested, but you can also find several longs that are out there which are working well within the staple sector, within the healthcare sector. For my portfolio has longs on the healthcare names, bunch of them. Gilead, I had taken it up primarily for dividends, but it
Yeah, I got
ended up giving.
I've
Yeah,
got BDX. Tom's BDX been working out good the last few days, and
there you
a
go.
few of his longs inside there. Can I ask another question, Robert?
Go for it.
Yeah, by all means, Arthur.
I don't know if you've covered it. I came in a little late. How are the signals looking as far as I saw in the early look, the consolidation of the dollar, and the narrowing of the range, and it's a bullish trend. But boy, it seems so heavy in here. I'm wondering if, and I know this is narrative bullshit. We don't know, but it seems almost like there's some intervention going on somewhere to hold this thing down. I don't know if anyone's got any knowledge or any comments on the dollar.
Arthur, you've said two big narrative-driven comments
I
right
know,
there
I
in
know.
the last 10 minutes, man. Just forget about it, right? Like,
Hold
just
my
follow it
beer.
anyway. But
Well, it's at the low. It's at the low end of the range. It's bullish trend.
I mean, it's not quite there, right? So it's 105.51 is that low end, so it's only on 106.41. So again, I mean, what's transpired? What hopefully everyone's seen in the dollar in the last sort of week or two is that the top end of the range, has come down, right? And
Yep.
so, and it's come down from what had been, making, close to either, certainly it would have been making, if we got to the top end, 1 month highs, and it was pretty darn close to 3 month highs, right? So
Yep.
the shift there, and now it's suggesting that we'd actually be making, if we get to the low end, aka 105.51, that would be new 1 month and 3 month lows from just a price standpoint itself, right? So, we're bearish trade and bullish trend. So this is it's tough when it gets into that environment. But at the same time, this is where we overlay the quad models and the nowcast, and we and we kind of suspect, right, or certainly the signal, again, the fact that it remains a bullish trend means that it hasn't broken down, and we shouldn't kind of cut those ties. But if you are a Macro Pro subscriber, you would have seen yesterday Keith took down the UEP exposure, and in conjunction with kind of macro stuff like that, so he's down at, although it's still his biggest overall position, it's down at his minimums. So I think that's when you're kind of combining the different product sets and stuff like that, you get a bit better feel and understanding for certainly what Keith Coach is doing in the moment. And what I'd say is that's kind of a direct correlation to what the signal is, obviously telling him, and that's that it's not as strong as it had been, and therefore you don't want to cut bait in terms of because it hasn't broken trend, right? So you don't want to cut bait in regards to completely getting it out of the portfolio, but certainly you want to kind of take it down to close to whatever your minimum sizing would be, and then kind of see how the kind of signal acts and or the kind of asset kind of works itself out over the next few days. I mean, the flip side of that, it would be kind of the euro, and the great the British pound. And then you've got kind of the Canadian dollar that we obviously get on a daily basis. The euro and British pound have been kind of putting in new higher highs, right, and the Canadian dollar's kind of been trading sideways. So out of that bucket, we think from a quad standpoint, and Drago went through this, or Richie did today, just about Europe and stuff like that, right? It's Europe remains a core short and that kind of thing, but right now the euro is kind of the signal's acting a little bit more different. So I think it's managing the kind of immediate term versus the longer term outlook, and kind of staying patient and picking your spots.
Hey, Robert, real quick.
Yeah, thank you.
Real quick on the dollar.
Yeah.
You and I talked about it the other day, and I can't find it in my notes for whatever reason. 105, low 105s is trend.
103, I think, but
Sorry, man. Phone call came in. Was that trend? You're looking for trend?
Yeah.
Yeah, 103.26.
Okay, but
Yeah, that's
but
what I
trade
thought.
is
Yeah.
up at 109.
That's correct.
Okay.
Yeah.
And,
Yeah. And
yeah.
again, that data is a little stale. That was last
Yep.
week. That was last Wednesday before the notebook review. So that's a week old. So I don't have the updated numbers
That's
from
cool.
Keith.
At the same time, updated Macro Pro shows a little bit active in UUP for those that didn't catch it.
Yeah, I haven't seen that re-rank yet. It came in kind of as I was jumping on,
Yep.
so I haven't seen that re-rank
Yep.
yet.
I didn't hear that. Active in what other? I didn't hear.
He was
what you
active
said.
in UUP, but I don't want to give it away. Don't subscribe
Okay.
to Macro Pro. That's up to Robert.
Yeah, I've only got Elite Pass, you guys. I'm not big
Oh,
shots like you guys, so I
stop
don't have
it.
all that.
Stop.
Yeah, but I mean, listen, but it does help, right, Arthur, in terms of understanding what's
Absolutely.
transpiring on a daily basis. So, but yeah, man.
Oh, I want to get there. My wife won't let me.
Yeah, I hear you.
Yeah.
But no, I mean, listen, but again, like that signal had been it'd been, if you're kind of writing it down and following it along over the last week or two, it should have been not, I won't say totally apparent, but it should be something that you're noticing, right? So whether you do anything with it, that's up to you. But that lower, like the lower highs in the dollar, I think a week ago, what was it? A week ago, we were sitting at 113 spot 45, right?
Yep.
So big difference. We're
Yep.
basically $2 lower. Oddly enough, it's 111 spot 45 today. So that's a huge difference from, if you're seeing my screen here, you can see that 145 would have been putting in a new 1 month high a week ago, and now we're kind of it'd be a lower high, right? So again, just kind of keeping track of what that signal's telling you. Right now, that's just consolidation. So really, that can be that can be, or kind of traditionally can signal kind of more of a bullish standpoint, right? Volatility is coming out of that asset class, and that attracts dollars towards that asset class. Now, is that going to attract it here at 106.45 or closer to the low end of the range at 105.51? We shall see. But I think it's again, that's a core long position, and one to kind of risk manage accordingly with as the signal shifts and that kind of thing. But yeah,
Hi, Robert. How you doing?
good.
Thank you so much.
Absolutely.
Thank you
Yeah,
so much,
Arthur. Yeah,
Robert.
absolutely, buddy.
Thank you.
Hi,
Hi, Robert.
welcome.
My name's Pen77, and I wanted to just give everybody a little heads up. I've been trading for 32 years. I don't trade commodities anymore. Other than I do buy puts on Bitcoin.
Sure.
But I think what people should really take a look at is the OTC market right now. In 2008, I had a horrible year. In 2009, I had the best year of my career. I have attracted the very, very risk on assets. So I've been playing the OTC as kind of my secondary income for the last 32 years. And the year following a bearish trend, usually you'll get some overflow of money that will come out of the retail Nasdaq and head into the OTC in an effort to find percentage gain. So
hang on. PM, are you saying to go long OTC at this moment?
yes, I am. I would go very long at OTC.
Okay, so we have discussed this in one of our prior sessions that we would probably be doing it after we have reached the end of the quad 4 signal, so we don't go just purely by what's happening running headline to headline in the market. We tend to have a combined approach of macro and the combination of price volume volatility. So are you aware of what this group is about in general, Pam?
I just taking a look. I'm very interested. Very interested. I just
okay. So
I
don't
did
go by
so well
charts in
in
general.
2009
Yeah,
trading
Pam,
on my hunch, and I never had a better year since. So
that's
I
awesome,
would
man.
really,
Listen,
yeah.
I'm really happy. I'm really happy for you, Pam. But we stick with the data, and that helps drive our asset allocation. So, I'm going to just kind of respectfully, kind of take you down as a speaker. But I wish you a very happy Thanksgiving and a good holiday, and I hope trading the OTC continues to work out for you, buddy.
Thank you.
Absolutely. All right, so Trent, you came up and jumped right into answering a question, but I don't know, or if you and Jimmy, if there's anything, Jimmy, yeah, you get your hand up. All right, buddy, let's rock and roll.
Morning.
Good morning.
No, I think you covered a lot of the bases. In fact, I was talking to Leslie and a few other the Hedgeye people before the weekly notebook review, and I'm trying to get a better sense of how Keith comes with his real-time alert signals. I think Trent, you've even talked about him as kind of more of a exhaustion type trader when he looks at breakouts and price volume volatility. When there's a lot of volume, it works great, and then on these kind of holiday weeks and when there's very illiquid conditions in the market, I think there's just as many trapped bears as there are trapped bulls, with different time durations. So it's interesting to see, over the months and years, when I hear Keith saying, hey, you got to come in and come out, especially in the chop bucket, you got to be quicker. Just look at his Home Depot trade, right? Like it is kind of gnarly because some of the other people I'm looking at on Twitter too that have different durations that use different signals, they were buying HYG. There was a breakout at 74.50. They were buying XLI this morning prior to the short. So it's a matter of duration, and it's a matter of how long can you hold on, and definitely position sizing. So this gets more and more complicated. I don't really know the ins and outs deeply, but I'm learning. So I think on a week like this, or when you have this kind of bear market rally, if all, and this is my narrative part, like Powell, after his, he shot that reporter down and he's like, hey, I'm gonna have to hike. If all we could get to was like the mid 3700s, like what's going to take us back down to 36? I think that's where a lot of the macro bear allocation, I'm waiting for that, the holiday season. I'm waiting for the earnings recession to really kick in. But it has been interesting that the buy the dip continues, and every successive quarter this year, it seems like, I'll say seems, but some of these, FANG earnings, 1Q is the worst. 4Q and 1Q, the names are down 20 something percent. And outside of the idiosyncratic pukes, there's been a lot of short covering. So I'm kind of curious to see how this winter unfolds, just intellectually. I'm still very hedged in my portfolio right now. Definitely short in a lot of different ways, kind of spreading my wings, but nothing's for certain. But don't have a lot of other observations. I'm actually just surprised that Bitcoin has held up so well. I think there's definitely some psychology behind that. But anyway, that's all I have right now.
Yeah, Mike T just jumped up. Before I pass you the baton there, buddy, it was only a short 10 days ago that we were putting in, certainly on the NASDAQ, pretty darn close
Totally.
to certainly 1 month lows, right? And so
isn't that wild? It was 10 days ago.
It's only been 10 days ago. So I think just kind of keeping everything in perspective, right? So anyway, but Mike, appreciate you jumping up. Hopefully you're feeling a little bit better from battling the COVID.
Yes. No, I got
Awesome.
I'm still coughing. It's been like 6-7 weeks. It's an absolute disaster. But I was able to get out to go to Vegas last week with my son to
That's
race.
Awesome, man. I was about to just said, huge congrats. I saw the announcement the other day.
Yeah, congratulations.
He's moving up to the cars, so that's unbelievable, buddy.
Yep.
Huge congrats.
It's funny, you don't realize this, but you interview to go on a race car team. So he has been interviewing since the summer. In cars, they basically they time you, they track you, they see how fast you advance, and they look at your racing resume, and they do all this, an inspection, kick the tires, big time. It's really fascinating. Anyway, yeah, it's wonderful news. Thank you so much, and we're gonna have a lot of fun. I'll keep you posted on how it goes.
Oh, absolutely! I can't wait to come to the live event.
So, guys, I want you to know, positioning panic has happened. Vanilla retard positioning panic has happened. Pull up Penske Automotive, pull up Ulta, pull up Pharma, all of Pharma, doesn't matter. even if ones that, and I can't really pick out specific ones because, I have a fund that I do tend to in that space. But there are some that have had, up 20% or so on the year in pharma that literally have 50% of their revenues going generic between here and 2028. And they're at all-time highs. And it's because of the flows. People, the vanilla investors don't know, don't care. It's all about positioning for certainty. And what I wanted to point out is that positioning for certainty is at the nth of extreme. We are at the zenith. We are at the apex of absolute pain, where they don't know why they're there. They're missing it. They're in total panic mode. Got to be there. Got to be overweight. Got to be sized. Can't be in. Whatever else it is that's cyclical. This is usually what happens before a real recession hits. And you've been commenting on the dip, and that the dip has kept being bought and kept being bought and kept being bought. And I'm going to tell you when it stops, because I know, because I've seen it twice now in my career. It stops when jobless claims go up. That's when it stops. When retail gets really worried because either they're getting fired or they know somebody's getting fired. And we're on the cusp of that. We're starting to see it creep up, and I expect a meaningful increase in jobless claims in the new year after a weak holiday season. So, but then we have, everyone gets excited on interest rates, of course, because, the Fed can pivot now. And that issue is the Fed's not going to be able to probably do anything until the back half of the year, like into the back half of the year. So we have this very, very large air pocket. And that's what I've been worried about this whole time, is the air pocket where the Fed can't do anything and the economy tanks and credit blows up and the Fed, I had a lot of discussions over the past 2 weeks on what the Fed is going to do. And the Fed is at a crossroads here because the administration, this White House, has demonstrated that it will forever engage in modern monetary theory, simply dumping stimmy checks on the public in order to buy votes, literally until there are torches and pitchforks on the lawn of the central bank. And we will engage in total hyperinflation. Now, this is exactly what has happened in Japan for the past 35 years, where they essentially have a one-party system, which is exactly what, every party here wants, a one-party system that has basically raided the cookie jar for 35 years of printing money and modern monetary theory, paying off the people. And then everything's fine until 1 year, their currency drops by 40%. This is that year for Japan. And this is the beginning of incredible pain. And it's very, very difficult to determine what that year is going to be and how it is going to happen, especially with very, very large economies engaged in this modern monetary theory. But this White House has put a giant bomb on the face of Powell. And they are basically saying, good luck, brother, because we're going to totally ruin it. And meaning that we will force you to go Japan, where you cannot find the buyer of the economy of our treasuries. It doesn't exist. And you will have to print in order to permanently suppress the yield curve and destroy the currency. And that's what they're really pressing this Fed to do. I don't think this Fed is going to play ball. I believe that this Fed knows it and they are steadfast, believe it or not. And the reason why they're steadfast is we saw it in 2018. We saw a glimmer of that steadfast inflation sensitivity in 2018. And right now, it is so serious, and that if he does not crash this economy in order to find a buyer for the U.S. Treasury, a natural buyer, we will be Japan. And if we are Japan, and this is the strategic issue that the White House doesn't understand, because I literally believe that the people in the White House are not American. They are something else. They are not American. They do not understand that it is that very attractive treasury bond behind a currency that is actually responsible, meaning fiscally, that gives us the ability to have our military. because we are essentially borrowing money from the world to fund the biggest, most powerful military, which is essentially the contract police. That's what they are. They police the world to engage in contract law so that deals are recognized and honored. And that's what our military is really all about, is contract law. And so in a long-winded way, that is the battle that is going on right now between the Fed and the White House. And if the Fed gives in and doesn't crash this economy, we will turn into Japan and not be able to afford that military. And that will be the absolute undermining of America. All right, my mic is dropped. On to the next.
Hey, Mike, before you drop your mic, how come, or can you give me some thoughts of yours as to why the Fed, if they need a natural buyer for treasuries, why they don't just reduce the interest rate that they're paying on RRP and get some of the banks to actually buy them with that money as opposed to just have it sit on their balance sheet?
That's not the buyers we need. That's Europe. That's how Europe works.
Okay.
Right? Europe essentially pays the banks to buy all the debt. So it's essentially all internalized into one gigantic debt bomb. We need foreigners to buy our debt. That's what lends the credence to our fiscal responsibility, is foreigners buying the debt, because our debt is more attractive than their debt.
Gotcha.
The moment that ends is the moment we can't have a military. And believe me, that's what China wants. That's how our situation gets completely dismantled. So let's keep that in your mind. I'm a little upset nobody talks about it, but hey, that's what this notebook review is for. It's for people to hear things they never heard before.
That's right. Now that I want to jump out a window. Yeah, sure.
Oh, by the way, I'm long. I'll tell you what I just did. I'm sorry. Most important thing for your notebook reviewers, believe it or not, somehow, like, I just got so goddamn long during this squeeze that we had, because I knew that it was going to be the nastiest unwind ever. And I came into that Thursday and Friday of the biggest unwind I've literally ever seen in my career. And I came in 100 to 120% net long, and I made zero. Just FYI. So my shorts were literally up more than twice my longs the entire way. And I literally made 0, 0, 0, 0, 0. And I was just thinking to myself, what I had to do to make zero in a hedged book was absolutely insane, and something I could never put that position on if I was in one of the pod shops. And the pods fired so many PMs. It's astonishing how many got blown out in the past 2 weeks. And it's been Fins, TMT, that's tech, media, telecom, and consumer books largely. Not so much healthcare, though there have been a handful of confirmed nasty blowups. So that's what's been going on. And that's why we're seeing a lot of disruption. So far as redemptions, I am estimating, and when I say I'm estimating, it's actually with a lot of data that's not out there. So I think we're going to see 15% redemptions across the board for most hedge funds. Not the pod shops, they've actually done well, but I'm saying some of these gunslinger hedge funds, 15% for the quarter. And I believe it's going to accelerate in the front half of next year. The privates have still not been marked down. They are still held up. They need to be marked down substantially as of 1Q. So January, I assume. So that's when we'll really see some performance getting whacked.
To these privates, aren't some of the larger financial companies' books exposed to a certain degree? So be it like the insurance companies or
Yeah, of course they are. Of course they are.
So do you have
and that's why we're seeing redemptions? I'm seeing redemption because I'm seeing it now where a lot of these pension funds, especially, they got involved with these privates, but they have a mandatory capital call that can be called upon them. And they've gotten that call in many cases and have had to liquidate their hedge fund positions to buy into the privates because it's required. And that's this is all part of it, the scrounging for money, and they're looking for liquidity. And this is why the hedge funds are starting to get whacked. So how I'm set up right now, I'm super size long the 10-year. You guys remember me talking about it, and I apologize. I was on Hedgeye. I was like, the only bet is the 10-year, and I apologize. I was literally like 5 weeks too early. So, but I'm there. I'm there in size, and I crossed. I'm up about 150 something this year, which is good. I mean, super good. That's crazy good. I usually only do 20 to 30%, but there's just been so many opportunities. It's ludicrous. And how I'm set up right now is that I've basically gone across the board, and I'm short a lot of these peaky defensive names that are just been marked up to the moon going into year end because they don't know what to do. And the probability of that persisting into January is extremely improbable. And I am materially long healthcare in general, but very specifically, I'm okay. How I'm set up is that I am long in size the fund that I manage, and I don't think I'm allowed to say what that fund is because this is not an actual call. But all of you can look up my name and see the fund that I manage, and that is what I am involved in on the long side, largely. So yeah, I have a super conservative book on, where I'm size long treasuries, long certain selective defensives. And, like today I'm size long John Deere. I have no idea how that doesn't continue to persist in the front half of next year. And then, of course, I'm long a handful of speculative small caps in size. And you guys may know what those are. It's PCT and Freyr, Frey. And those are my very large speculative small cap names that I'm involved.
Like nothing on the semis or home builders. We had an interesting number that
short
came out
home
today,
builders,
632.
Short home builders, short everything associated with home building. I think
Semis.
What's that? And then semis, I don't really have a position in semis because in my experience, when jobless claims start to ramp and the capex implodes and all that stuff, all this stuff gets destroyed. That's what happens. I mean, you get a real classic recession, and this is what people own still. So I think they're, I'm just not there. I don't get it. I'm also a bit short energy now. Let me rephrase it. I'm a bit short oil. I'm a bit long everything else.
So you mean like the underlying commodity, right?
Yeah. Well, I actually own it through stocks rather than commodities. I hate trading commodities. Oh, and I'm also
you're
short.
You're short oil, meaning so you're short oil through underlying commodities that have oil exposure, or through
short through stocks.
Okay, got it.
That have exposure.
Got it. Okay.
Yeah, because that way you can get geographic about it, and and actually pick on balance sheet and all that stuff. So I generally like to have my commodity trades manifest through stocks. So that's my take. Do you guys know, is Stork going to blow up in December? Because they're in this grace period, and I have no idea how they get out of it.
Which one?
Oh, for MPW. I don't know if you guys are following it, but
yeah, we are following it. So yeah, I mean, currently there's no additional intel other than the fact that the December catalyst event is in place. There's some rumors on the street that MPW might throw in one more shenanigan, one more last act in order to skip that eventuality for that time and just kick it down the road. So kick the can down the road.
Okay, because I've been watching this, and I came to the conclusion I understand their business now. Their business is just to pay them and their cronies for building all these hospitals and all this shit, and just pay themselves extremely well and run this thing into the absolute ground and just keep it going as long as it can. And then when it blows up, oh well, restructure and do it again. I'm not kidding, because you look at what they're paying themselves. They don't own the stock. They don't freaking care. This is just a game where they're just, and they're capitalizing on kind of like inner city sick infrastructure, desperate communities, and they're just basically excising incredible funds from them at elevated rates, and it's all scam. They're all collaborating together to do the same thing. And it's essentially like really, really screwing the cities that are desperate to begin with and paying themselves enormous amounts of money and giving loans to themselves through the company. That's it.
Yeah,
I mean, a total scam.
Rob had a good update post the West Coast NAREIT conference late last week. So if you haven't seen that, Mike, maybe take a quick look.
I'm sorry, I didn't. I've been in bed for like 6 weeks. So
no, you're good. You're good.
Yeah.
I can get the guys to send it over to you as well.
All right.
Yeah. Sorry, there was when you were talking. Deer.
Yeah, Deer.
Great quarter. Like obviously, markets liking their quarter, the earnings that came out.
This has been all year. This has been a top. It's about 12% of my book.
Okay.
So maybe 13, 14. So it's pretty sized. You know, my longs are generally. You know, people think I trade wildly, and I do trade a lot. But my long positions, generally speaking, I own them for unbelievably long periods of time, frequently years and years and years, and I'll trade around them, but I'll own them. I'll bring new ones in and take some out, but my high conviction long ideas, like Deer, I will own for an extremely long time. And you look at it, it's up 28% in a year that, you know, most things are down, and, you know, just do the Deer versus Zoom spread or whatever. And that's kind of like my year in a nutshell, or, you know, Deer versus Wayfair. That's kind of, I have a lot of shorts that are down 70 to 90% now, and a handful, and I haven't gotten them all right. Like my PCT is down 30% on the year, but that's okay when you have shorts that are down 70. So it's you can do all right. So the thing with Deer's going to keep going. As you know, this is a monopoly. They have a monopoly on technology, on equipment, on servicing almost. It is one of the greatest businesses ever, and the biggest problem for Deere moving forward is that the cost of capital for the farmers have gone up materially, and the catch is it's kind of like the chicken or the egg, which is funny because it's a farmer. The chicken or the egg. Oh, here's your dad joke, chicken or the egg. Okay, why did the toilet paper not cross the road?
I don't know.
It got stuck in a crack. So, yeah, it's like the double laugh, right? All right. So Deere's got that problem with the cost of capital of the farmer. So the farmers are going to have real cost of capital issues going for the year. And what people don't realize is that's going to hurt yields pretty bad at a time when pricing is through the goddamn roof. So I think we're going to see like unbelievably painfully high food costs next year. And it's really, it's kind of three things, or four, if you will: seed, fertilizer, ultra expensive; equipment, crazy expensive; financing, crazy expensive; and lastly, total disaster, diesel. Diesel fuel's through the roof, and it is a huge cost. So this is worldwide. The capital that's going to be required for the farmers to get to their yield is scary. Just FYI. So Deere's going to be okay because they literally have 1 to 2 years of backlog at any price. So, you know, they're going to be fine net because people have already budgeted a year ago for the crap they're buying, will be buying next year. But the issue is I'm really worried about food prices for 2023 and beyond. Extremely worried. I don't know how we get out of this.
Yeah, I remember you that was a core subject matter of your topic at Hedgeye Live, was around food inflation and stuff like that. And things really haven't changed even 6 months later.
Worse. It's much worse. It's much worse. And I'm really, really worried about it globally. So we're going to have, after this summer now, we're already going to have food problems coming into next year. And it's just going to accelerate. This is a multi-year event. And, you know, the Fed can only look at this and be like, oh, crap. So On the inflation front, because we didn't get to talk about it, there are a lot of encouraging signs using the metrics that the Fed will look at. And that's the rental rate. Well, let me rephrase that. It's just rents. Like rents, pricing on rents has rolled a little bit. And that makes for really good comps. You know, energy has basically been held in largely because of the SPR drain. And it looks like wage growth is, I mean, basically the Fed is getting, you know, what they want / need. And a lot of it's going to be performed by the comps. But at issue is there's still incredible inflationary things that are like right outside the door. Like if the Fed doesn't drill us into a real problem, and we do have what they call a soft landing, inflation is just going to come roaring back. And as you know, take a look at the Treasury now. The Treasury is now funding themselves at 4% plus, and they cannot do that, period. They need to be at like 3, and even 3 is bad. So something's going to happen. Something's going to happen. Where I think the Fed people will be like, the Fed is off the rails. They're making a terrible mistake. And that's only if you think in the very short term and you think through the guise of stocks or the lens of stocks. They're making a terrible mistake for companies and stocks. But for the Treasury, which is their real job, is to make them look solvent, they're doing the right thing by drilling the economy. So I think we're going to be at this amazing sort of crossroads here within the next 2 months. And it might be starting in December. Well, yeah, we'll see it in December or January, where the inflationary things are going down. Everyone's looking for a giant pivot. And the Fed's like, yeah, no, not at all. None of that. And that's because they actually need to get the 10-year down to like 2.7. And then after that, when you have a real recession and, because we'll have a huge inverted yield curve at that time, then they'll get the short end of the yield curve down because it'll be obvious that they're going to pivot because we have 6-7% unemployment.
So, Mike, have you looked in this kind of setup and this kind of scenario at things like, there's these small, relatively less liquid names like AGNC, right, Agnico, or then there's another one called, there's an ETF called CMBS. Some of these names, they look like they would get marked down further because of the scenario or situation that you're depicting. Have you ever thought of getting,
I don't even know what this company is. What is it? What do they do?
Agnico?
I'm sorry. Remember, I'm a troglodyte. I'm like a novice at this shit. So,
yeah,
so I don't even know what it.
No worries. So CMBS things? Is an ETF that actually gives you access to CMBS.
Okay.
Yeah, and so commercial mortgage-backed securities have been a problem right now, right, for a while. So let's start with that one. Do you have any thoughts? Because utilizations have actually really come under, and pricing is not that great in that sector from both comp perspective as well as from actual money making.
Well, that's fascinating. But why don't you just buy $100 million of the 10-year and beyond?
Got it. So
right?
Because you're saying that eventually this is going to basically just happen anyway. So just focus on the high probability setup of the 10-year. Okay.
Oh, yeah. That's like crazy liquid and you can be levered like 50 to 1.
Yeah, yeah. Of course, yeah.
Right?
The options,
that's the goddamn trade. And I don't know. And the other one to trade, oh, God, I even hate saying it. I'm like, long the yen. Oh, I can't even say it.
Jeez. Goes against every bone in your body, right?
Yeah, it's like diarrhea coming out my nose. Ladies and gentlemen. Yeah, so there's and I can't bring myself. I literally, I can't bring. So one other thing, and I was talking to Keith about this the other day, and he immediately called me. So they got new guy that's not Kuroda in Japan, by the way. And this is the problem with new guy. New guy is going to have an idea that's different than the old guy. Now, he may come around to the same conclusion where they just print money forever. But new guy is saying, we can't do this. We're not in an emergency anymore. We shouldn't be printing like this. And that's what he's saying. If he comes out there and he says that, like at the microphone as the new head of the BOJ, you are going to see the biggest, fastest collapse in assets ever. Like kaboom, daisy chain, bed shit. Just absolute insanity.
Just Japanese assets or global assets?
Oh, it'll be Japan for about a hot second, and then it'll be everything. Because the entire world is tied to a Japanese 10-year that is free.
Yeah, they jump in to buy our treasuries too, right? Because they want more yield, and their insurance companies also jump in over here to buy a whole bunch of rates. Yeah.
Yeah.
They
say if they're going to let it go, and even to a little bit, and interest rates go up to, let's go crazy in Japan. Say interest rates go to 1%. It's a total 3-alarm cataclysmic disaster.
But that would be a headwind to your US 10-year thesis, no?
No, because the entire world will blow up like you can't possibly imagine, and everyone will buy the 10-year because there'll be nothing left to buy. So you may get disruption, but just watch that, because that's one where the yen will go parabolic up, and nobody's trying. And even, our good friend, well, I won't name names, but some of the very influential people out there called me up because I said this, and they said, that's not what's going to happen. They're going to cave. They're going to totally cave and keep printing money. And I'm like, yeah, you're probably right. But there might be 3 weeks where they don't, or 1 week when they don't, and it won't matter. You will see markets absolutely get shellacked like you can't believe. So just keep that in the back of your mind on the BOJ, because new guy has singing a different tune than the old guy, and everyone's going to hate it because everyone likes free money forever.
Yeah, I mean, and for taking back kind of the notebook for a minute, it's the big lower high on the USD JPY, both day over day and week over week, right? So that came in at 146.77. It was 148.01 yesterday, and 151.93 a week ago. So it's a higher low as well. So that came in, the low end came in, came up a little bit. So that's
chart. You buy the crap out of this chart.
It's consolidation, but yeah, it's but yeah, it definitely.
No, this chart looks like Baxter.
Yeah.
Maybe pull up Baxter. BAX. You guys pull it up on your Bloomberg. Oh my God, it is the same chart. Holy shit. Wow.
Pretty much. Yeah. Awesome.
So,
we got a couple questions out in the universe there, Michael. So let me go to Raj first.
Sure.
And then we'll go to Lucino. Hey, Raj, welcome.
Yeah. Hey, Robert. How are you?
Yeah, I'm good, man. Happy Thanksgiving, buddy.
Yeah, happy Thanksgiving to you guys too, and everybody out there. Actually, Mike just threw a lot of stuff out there, and I had a couple of questions. So, just thinking about this, I mean, would you go more long than short till the end of the quarter, or end of the year, I should say, and then go more short than long starting the new year? Is that something that is that a reasonable way to think about it? And the other thing, if Japanese yen is going to go up, that means the dollar would go down, correct? And when do you foresee that?
It's already happening.
Okay.
So sorry, Rush.
Yep. So, would the first question, would you go more long than short on stocks, or?
Well, I tell you what I'm doing. I just bought a crap load of puts on the Qs for the Fed Wednesday.
Okay.
Because I think he still has to come out swinging, and he's going to do the same song, and everyone thinks it's going to be like, oh, he's going to pivot. No, we have to stay vigilant. He's going to say words like that. Expect a lot more where that came from. Crap like that. And because he really needs to tank this economy pretty bad, and it's not happening.
Okay.
So this is mid-December, right, Michael?
When is it?
Yeah, it's 14 December or 15 December.
When is he talking?
And then CPI is just a day before that.
That's what I bought. Sorry, remember, 6 weeks COVID. All right. CPI. Actually, CPI is going to be encouraging.
Yeah, first CPI and then the Fed. Oh, it's one after the other, day after day. Yep.
13th, 14th, isn't it?
Sorry, what I did was I did a bunch for the Fed. And I'm a little bit early on it. So I did a calendar spread, so I didn't pay so much for it. So what I basically did was sell the week before and then buy the week after. So I'm helping to offset the cost of the theta. Does that make sense? I do that a lot around events, whereas I'll sell the vol before and then buy the vol after. So it kind of offsets. And sometimes I get it wrong, where I end up missing the entire trade because crap moves in front of it. But it does. It keeps my cost down. Because right now, honestly, options are so expensive. I don't know where this VIX is getting off.
Hopefully he can join us again. Luchino, welcome.
Hey, welcome, guys. Hello, guys. Happy Thanksgiving.
Thank you very much.
Long-time listener, but first-time speaker.
I appreciate that very much. Hopefully Mike Taylor can join us in a minute, and very sorry for my mistake there. I accidentally, I don't know what happened actually. So it's but we'll get things back up and running here. And then was your question? I think your question was a bit geared towards Taylor, though.
Well, I don't know. It's actually to everyone because
okay. Let's rock and roll with your question. Then we can get the ball rolling.
It's more like because I'm hearing a lot of people speak about the Santa Claus rally and about what is happening in the narrative and in the space right now. But does it make sense to push books end of year because it increases taxes while next year could be worse than this year? And what about tax sale loss? And I had a second question, which is what catalyst would make the VIX go back up to the F bucket if inflation keeps going down? We hear Keith talk about the GDP. So could it be that the focus is shifting from inflation to GDP and to recession instead of inflation coming down?
So I can trend here. I can try to address both of them based on what my view is. So first one is you asked about tax sale or tax loss sale, right? Tax loss sale definitely happens because and the way it manifests itself is typically companies which are significantly down for the year unless there's a major catalyst news-wise. Otherwise, they tend to keep drifting lower and lower and lower. So, and that starts happening somewhere from around middle of November all the way up to the end of December, because RIAs have a fiduciary responsibility to advise their customers that, hey, uh, you should try to do tax loss harvesting in order to make you know uh, make make this beneficial for you. So tax loss harvesting definitely happens. The worst affected stocks by this are especially for, say, when you take the Russell 2000, find out relatively less liquid, but anything which has more than 0.1% exposure to Russell 2000. And if there's an ETF outflow, right now, if you look at it for the last 1 month, there has been an ETF inflow of about, actually, just month to date in November, we had more than $114 billion, $114 billion worth of inflow for the ETFs. And what that means is that any such tax loss harvesting that was going to manifest itself has kind of gotten slightly washed away. And this is not money sitting on the sidelines. This is potentially some of the money that, or this is some of the aspect that Jimmy was also saying, right? Hey, there's a buy the dip going on. Every time it goes down, people try to buy the dip. But the biggest buy the dipper, right? Marco Kolanovic from JP Morgan Asset Management, who used to be a quant head, and now he's kind of more on their advisory side of the house, not for retail, not for the wealth management, but more for the asset management, more for the institutional. He completely capitulated and said he was having actually a year-end target of 4,800 or more on the S&P 500. I actually respect that fellow, generally speaking, but not specifically this year. He was dead wrong on many aspects. He tried keeping, you know, his target for such a long time, and then just recently, last week or this week, he came up with a statement saying, "Oh, it doesn't look like Fed would. I mean, it doesn't look like without the Fed cowbell or Fed stimulus, this is going to act." So I hope that answers your question on the tax sale piece. That tax sale definitely affects, and anything which is down quarter to date, anything that is down year to date keeps getting hammered more because of that. Second,
but general rule of thumb, general rule of thumb, it typically goes through kind of like the 15th of the month of December.
Right.
Just as a general rule of thumb, but yes, just wanted to highlight that piece as well.
Right. And then the second part, you asked about wicks. What would be the catalyst? We were just speaking with Mike T earlier.
Trent, sorry, before you get into that, the Santa Claus rally, everybody's got, like, no offense, but, like, stop talking about it. It's not a big deal. It's narrative driven. Just do what the signal's doing. The signal's consolidating right now. So right now the signal on the bottom end is not saying we're going to get new lows. So just deal with it, right? So, like, deal with that and deal with the fact that the top end is not a breakout. So it's not making new new highs on a 3-month basis, on a trending basis. So just deal with what it is. The Santa Claus rally, people, that's mainstream media, like, bullshit. That can come into play. We might get a rally, but who the hell cares? Just do what the market's doing and do what the game is doing, and don't try to put your bias in regards to either being short or long, or kind of expectations in play here. Just kind of let the game come to you and let things play out. Right. So right now, coach is at a a little under a 5% net short position. And some RTAs have come out, so I don't really know what he's done kind of in the last hour or so, but that's kind of what he was coming into the day, and just let that guide you. So it's he's not net long, but he's certainly not to his max of minus 25% net short either. So I'd call him kind of like in that neutral-ish territory, with a bit of a bias to the downside. So I'll leave it at that. And then Trent, I'll if you want to dive into the VIX catalyst.
Yeah, so on VIX front, this has been a standard pattern which we have observed for this entire bear market, right? Which started somewhere in November last year, or even January, you can say. I mean, I sold most of my long only stuff when Josh came out with that macro show presentation. I actually heavily sold a lot of my risk on kind of assets, and started turning short. But one of the aspects that I've notably observed is that whenever VIX goes above 30, we end up getting these wall targeting funds or even wall selling funds, which try to promise neutral positions but highly uncorrelated returns for some of the larger portfolios, such as pension portfolios, endowment, etc. In fact, a few weeks ago on one of our weekly notebook review, I've even made an observation that 16 days, 16 trading days in a row, we had VIX continuously going down. Back then it was about 25. And right now that number is at about 27. So 27 trading days, only 3 or 4 days VIX kind of ticked up. Otherwise, every day it would open, close lower, open, close lower. Now, typically, what tends to happen is whenever we have something which is deviating from the path that was expected or some sort of unexpected risk pops up, that's when we'd get a pop in wicks. For example, in between, we saw some issue which happened at the Poland border, right? But here are some of the catalysts that are yet to happen. Number one, the CPI that's coming out, which we talked about when Mike was here on December 13th, the FOMC guidance that will come out on December 14th about how they're planning to chart out the course of action. They're definitely not pivoting. There's maybe one day dove in form of Brainerd, but other than that, everybody else is still hawkish, and they're saying that it's almost like an antibiotics course that you would have to take if you end up getting some sort of infection. You don't stop it at day 3 just because you start feeling better. You have to finish your course of all the 5 days if it's a 5-day course antibiotic in order to make sure that it's effective. Otherwise, the thing keeps popping up, or you may have much more severe infection. So similarly, in monetary policy, we haven't yet truly seen a 100% path that if Fed decides to pivot right now, that we would get inflation and control down to like the 2 or 3% range. What are they targeting? And then that would just make them not only ineffective, it would actually take the inflation anchoring away from them, and then the credibility is lost. Once credibility is lost, it becomes like Japan, right? You don't want to have a central bank losing credibility. The central bank knows that. So definitely their tone when they come out in December is going to be hawkish, just like it was hawkish in the last FOMC. So those are two catalysts I can think of. We will start hearing more details about the energy related issue and how consumption has just fallen off the cliff with more numbers that are coming off. So, for example, today we had some of the European flash PMIs coming out, like German flash PMI came out. It was still in contractionary mode because it was below 50. We'll start getting more of those data points in Europe. And how does that affect us? S&P 500 has more than 47% of its revenue coming in from international. Of that 47%, about 32% comes out from Europe. So think about it, 32% of overall S&P 500 earnings comes out of Europe. If that's contracting, if that's not growing, then what are you going to show your S&P earnings numbers from? People were trying to defend 240. Right now, they can't even defend 210 on S&P 500 earnings. So these are some of the catalysts as we finish off. This earnings season was really bad, extremely bad as far as companies trying to meet estimates. Major secular companies have not been able to meet estimates, such as Google, such as a whole bunch of other outliers which have continuously beaten the overall estimate. So I hope that addresses both your questions, Lucina Capital Group. Yeah.
Thanks, Trent. It was very helpful. Can I just follow up on something?
Yeah, by all means.
GDP is coming out, I think, the 30th December. Can that be a catalyst for something to happen? Because when I'm looking to the slides for the nowcast or the forecast from Hedgeye, I'm thinking I'm seeing a lower number than what is consensus. So, or maybe I'm not seeing it right.
Sorry, I'm just pulling it up now. So CPI, you're talking about Q4? Lucina?
The GDP, yeah, GDP for the
GDP?
3rd December, 30th November, excuse me.
Yeah, sorry, did we put that? I know we put CPI in the morning in the.
Yes, I can see real GDP year over
Okay.
year and real GDP.
Perfect. If Genron, if you can throw that up on the screen. Yeah, this is TMS. So sorry. Yeah, this TMS this is what everybody got this morning, but I'm not seeing it in here. So Genron, there was CPI. Can you show the GDP number? And I know CPI we were looking at about, I think it was 4 and change if memory serves. Sorry, just give me 1 second, Lucina. I should know this number off the top of my head. Here we go. So CPI, we've got it's hard for me to see that number. Q4, we're headed to, in Q3 23, we're headed to kind of 4.55. In Q4, we're looking for 7.52 in that regard. And then in on the GDP, shit, this is like super small. Can I get this bigger? Here we go. GDP is bigger. We're looking for basically, call it 0, in Q4. So like 0.74, Lucina, is the Q4 number that we're looking for versus Atlantic Fed estimates of around 1. So we are kind of below that, and then the consensus estimates do look like they're a little bit below that. So I'll double check that number in terms of what the consensus is saying. But you're spot on there in terms of what that looks like.
But I'm looking at right. Yes, is the file, the slides where you can see what are the quads, and then you have the GDP year over year, and the graphic with the quads. That's the estimates on the right side up. That's the good spot.
The estimates so in today's macro deck, it was slide 13. Are you looking at 13?
Page? You mean page?
Page 13, yeah. Are you looking at page 13 on the macro show slide deck? Is that what you're looking at?
Page. Let me count it because I cannot see which page
no problem.
it is.
Yeah, so in there on that slide, we're showing real GDP year over year, and then we're getting to the estimates for Q4 and going out to Q3 of 2023.
Also note that although GDP and GDP rate of change is one of the factors or one of the features in the model, there are 21 other features, right? So in addition to spending time on looking at GDP, definitely look at multiple other aspects. Also, keep in mind, the catalysts keep coming. There's one catalyst which is coming up in an hour called FOMC meeting minutes. Now, that's not a part of the Hedgeye model from a features perspective, but I just wanted to add to your list of catalysts which you're trying to look for.
Yeah, and Trent, that's a great call out. So today's deck from the macro show was chock full of data, and it actually includes the real GDP kind of nowcast model and the top. I believe there's top 30, excuse me, in terms of features that backtest, and those are some of the key components that go into and influence the nowcast model, Lucina. So if you're a macro show subscriber, you can go to that presentation from this morning, and on slide 14, which I'm actually showing on my screen right now, you can see kind of the data print, right? So if you're kind of looking on a year over year basis, that would be kind of this November, December timeframe, even October, because a lot of this data that's coming in is for October, obviously, of 2022. And you can see a lot of it was kind of like faint green, not quite as green as it was back in April and May and June of 2021, but still sort of certainly positive, a lot of green on that screen there in terms of the October to December timeframe of 2021. So those are the comparisons that we're going up against, and certainly information or the data is coming in, and it's coming in quite negatively, certainly on a year over year basis. So for instance, retail sales, headline retail sales, which is the sixth kind of most influential data point from a backtest standpoint, that was came in for October at 8.27. versus a year ago at 16.62. So almost cut in half year-over-year basis. But great call out trend. So that's the nowcast model, and then the quad map, Lucina, as you were talking about, that's kind of where we chart the GDP and CPI and get the quad, where things are going to go in the quad situation. And then remember too, and I talked about this on a beginner's guide on Friday, a few days ago, that in 2019, that quad map was 75 basis points wide in each direction, so 75 by 75. And then on the and now today, and so kind of 2 years later, it's 250 basis points wide in both directions on the X and Y axis. So just keep that in mind as you're seeing. We just have had, obviously, things have gone to quite extremes, both positively and now kind of negatively.
Thank you very much, Robert. Thank you very much, friend. I'm only Elite Pass, so I don't have everything.
No, Elite Pass you have macro.
Yeah, I have a lot.
Right?
I'm joking. I have a lot.
No, but you have the macro. Yeah, you got the macro show on that. So
I have
look at
the
that
macro show, the call. I have
so
ETF Pro. I have
100%. So the presentation today was chock full of I mean, that's 53 slides in it. So it's a bit different than the traditional macro show kind of presentation that goes out, and really that's because of Drago and Richie were on the show this morning with Jonesy, and they're are I mean, we're all data junkies, but especially those guys. I should say data jockeys, not junkies, but we love the data, right? So, but today's deck, I definitely, I don't know if you're here in the U.S., but over the weekend, definitely if you get a chance, kind of dive into some of those slides and review, where we are in terms of the data that's come out and that should be coming out. That's a lot of folks have asked me about kind of the weekend work, and that's a piece of the puzzle in terms of trying to trends been rhyming off a number of the different kind of catalysts and events that are on the calendar. You should be writing down a lot of those over the weekend and kind of going through, cross-referencing, maybe, again, maybe start small depending on what you're doing, but maybe the top 10 to 15. But obviously, if you really want to do this well, you should kind of track, the top 30, features that influence the nowcast model, and know when those catalysts are coming in, right? So when those data points are going to get updated and that kind of thing. So, they're not every week, right? But certainly kind of knowing when those are going to hit can be very obviously influential in regards, and again, they're just data points, right? So it's like one tool in the toolbox that influences the nowcast model. But knowing when they're going to come across, especially really key ones like real PCE is the number one factor that goes in, and yeah, so just kind of knowing when that's coming across the horizon and that kind of thing should help you just better execute.
Thanks, Robert. Thanks for the explanation. Thank you very much.
Yeah, you got it. Absolutely. Cool. So again, I feel badly. Mike T got cut off there. Sorry, buddy. If you're listening in on this, I am very sorry that happened. It was purely a McGrory gaffe. I think that's only happened once in the last year, so I'll just chalk that up to me being an idiot. But we got Muni guy that jumped on. We have been going for kind of an hour and a half here, so I'm I know it's sort of take two, but I think kind of wrapping things up, unless we got anything really new after Muni guy. I know he's probably going to give us a great update in the Muni space. So we'll Brian, welcome. Happy Thanksgiving, bud.
Hey, thank you, Robert. Happy Thanksgiving to you.
Thank you.
I think I did a post this morning. Black Friday. I was like, oh, I gotta rebuy my Macro Pro on the cheap, right? And I realized it just renewed, and I was like, the 21st is my anniversary date. I'd forgotten the exact date, so I put a post up about my renewal and my 1 year anniversary, and just I'm kind of spending time today being thankful for certain things, and one is Hedgeye Nation, just the relationships and the just the ability to talk about things over Twitter and being exposed to things I wouldn't normally be exposed to is just great. So I'm thankful for Hedgeye Nation. I'm thankful for having a team behind me. I'm also thankful that I didn't get wiped out by SBF. That's like on everybody's mind right now. So that's been kind of comical to watch. But so I just jot down a few things. Not much here in the primary market. Deals coming to market. They're getting done very healthy right now. So if you're seeing robust participation. I put a post up. We saw inflows into muni bond funds. Definitely feel like the supply demand column is shifted towards people buying bonds and just having less supply out there. I've been talking about that for a while now because with the holidays, they're playing their role to suppress volume. There are less days of the year to price bonds. And so that means that issuers, they plan their issuances accordingly. And so you'll see, even though the post I did this morning says that volume's up on the 30-day outlook, it's only because people have piled in a bunch of bond issues within this a period of time, but it will revert. The key, though, is the secondary market. So there, it's pretty much dried up. I put in the post, I underlined the Muni Center. So Muni Center is it's a platform in which dealers trade bonds to each other at wholesale prices, and it's continued to dry up. Last week, I picked up two nice odd lots, high quality names, a 4 coupon to yield a 480 double tax free. And the best bond I see today is 4s at a 435. So, things have been pretty gobbled up in the secondary, which again supports the supply demand equation I've been talking about. From an issuer example perspective of kind of what I see going into next year with some clients, I worked on and have been working on for almost 2 years now on a very large detention center. We don't call them jails anymore. We call them detention centers. I'd been running it at 55 million, and I just got an updated figure of 89 million. So definitely some construction inflation, and then when you add on that, you have interest rates have increased. Even though they're a high quality name, their deal will get done. It's still at a little bit elevated level. In terms of what they were used to seeing during the QE phase. So I see pressure on people dollar cost averaging projects downward as best they can. But what I'm telling our issuers is that rising unemployment is their friend. And all you have to do is go back to 08 to 10 and remember when we hit the recession, all we heard about was, use local people and people need work and all those types of things. So I think the labor components of these projects will come down. I think interest rates, by and large, will come down some, but they'll still be higher than what we saw during QE, which seems to be the supported narrative from the Fed and what they're trying to do to bring inflation down. And then lastly, I guess, just kind of since things are kind of wrapping up on the bond world to year end, there have been a number of fellow Hedgeye guys that I've been working with. And we've been sort of building out our muni bond portfolios together since about June or July. And so a shout out to those guys who, learned how to buy bonds in the primary market, built out their portfolios. As I've posted, I am 51% long duration individual municipal bonds. Most of that is because I'm just over 50 and I need and want the income. So it's a little bit of a different viewpoint than I know a lot of people have. But, I've really hit it hard this year. And then lastly, I posted this morning, my limit, actually, I could not believe it didn't hit. We had a freaking haircut and I missed it. But I put a short on TQQQ. So I'm shorting the 888 bull. And I did a little bit of analysis of if you just shorted triple Q on its own, what would it have done year to date? And then I said if you would have just purchased SQQQ, which is 3 times leverage short triple Q, what would it have done? And it as you can see my post, it is a massive amount of differential. And Mike Taylor is the one that brought this up a while ago on a notebook session. I just sort of been keeping it in the back of my head, and I finally decided to do the work and look at the math and the decay on the SQQQ portion. If you're holding a core short and you're able to do it, shorting it, the traditional way of shorting as opposed to an ETF short. It really was sort of stark to me to see the math differential. So hopefully my limit order will hit. I am building my shorts up going into next year. And, my horizon in sort of grossing up my shorts is really more long-term. I'm more full cycle. So I don't plan on buying and selling them. I plan on holding core positions. So that's really kind of what I'm doing. That's kind of what I'm seeing. I think rates are doing what they're doing, and I'm interested to see what Keith does in terms of rates from here. But I heard a lot of talk about narratives, and I'm like you, Robert. I don't give a shit about narratives. All narratives mean to me, as an example, is an opportunity to arbitrage. And I hope to have 1,000 narratives on the bull side between now and the end of the year, because all it means is I'm just going to continue to incrementally add to my short positions, and not only will I take advantage of the full cycle of the recession, but now that I'm going to be shorting the triple weight bull, I'll also get that decay, along with it. So that's all I got, Robert. I know that we're kind of towards the end of your call here.
Yeah, no, thanks, Brian. Appreciate it. Some good insights. I think although Mike Taylor has talked about kind of the, taking the other side of the inverse of the bulls to short, right? I would just be conscientious of what you're doing on those. This goes out not just to you. I know, Brian, you know what you're doing, but this goes out to everybody out there. And even the SQQ, right? It's 3x levered short, and obviously there's, when things go against you there, the reason why I suspect, anyway, you kind of got to be actively managing, most of those, all of those really across the board. And I just would encourage you to do that.
Absolutely. You know me and my triple eights. I get them right all the time.
That's right. All right. So, with that, I think, again, appreciate everybody. X2, I know you had a question, but if we can kind of put a pin in it to maybe next week, I'd appreciate that. And we can go from there. So sorry about that, buddy. But yeah, I think we're doing notebook review again. It's earlier date. You only get a few days off here, boys and girls. So we'll be back on Monday at 2 p.m. So again, that'll be Monday at 2 p.m. Right after the long weekend. Hopefully we'll get maybe take a little bit of a different approach, rather than doing a kind of a midweek kind of update in terms of what we've seen. We can kind of get into what we're kind of seeing post some weekend work over the long weekend. But with that, I appreciate everybody's time and energy. Thank you to all my speakers, and Mike Taylor, who I accidentally kicked off, or not really, but I accidentally ended that for our space. So sorry about that. And happy Thanksgiving to all. You guys are absolute rock stars, each and every one of you, and I'm very grateful for all of Hedgeye Nation, for all the love and support that Hedgeye gets from all of you, and especially myself on these notebook reviews and the most recently Beginner's Guide. So with that, I'll bid you all adieu, and God bless, and have a great Thanksgiving.